Welcome back. Welcome back. We are back with another episode on Wealth Wednesday. My name is Corey Phillips. I am the founder and CEO of Social Storm. We're dedicated to teaching financial literacy and entrepreneurship, professional development for economic growth. And I'm back with my personal show called Wealth Wednesday. I'll be here by myself today. I have this thing pre-recorded, but definitely want to share this information and stay consistent. Again, make sure to subscribe to our YouTube channel, share this out to your friends and family so we can continue to build wealth collectively as a group, and we can also change our communities overall. Me, myself, I teach over 2,000 young people teaching financial literacy throughout Chicagoland area. I was featured on Black Enterprise, ABC7, and MarketWatch, working with various organizations teaching young people about how to manage money and build wealth. So make sure to subscribe and follow for more information. So we have a lot of information this week, a lot of things that you should all be updated within the markets and how we can continue to just know what's going on. So I'm gonna get straight to it. Make sure to follow me on Instagram at CoreyPhillips3, Social Storm Network, CoreyPhillips.org. If you want to book me as a speaker or collaborate, feel free to email me at CoreyPhillipsOfficial@gmail.com. So looking back, we have a lot of things happening within the markets, within stocks being all-time high. Gold has hit $4,000 per bar. It's the first time ever. It's also up 50% year to date, which is driven by a lot of many different things. For people that don't know, there's the commodities, and gold has typically performed under uncertainty. This has currently happened after the U.S. government shut down recently. Uncertainty. The tech sector has been very expensive at all-time highs. There's been a lot of rate cuts signaled by the Federal Reserve after 0.25 basis points a couple weeks back and potentially 2 more this year. And then a lot of record central bank buying, which continues to diversify away from the U.S. dollar as they have continued to have federal rate cuts, which has a weaker U.S. dollar. The U.S. dollar has devalued tremendously over the last year, 6 months to a year. So it's going down, which have boosted different institutions and Federal Reserve going into other monetary policies, such as going into different commodities and things like cryptocurrency and safer different alternatives outside of cash and then just stocks. And also a lot of geopolitical turmoil within U.S., Gaza, France, Japan transactions. And a lot of people like Ray Dalio recommend a lot of people to have 15% of their portfolio in gold, which is up from 10%, which typically might be people a hedge against debt, inflation, and then stocks as well, so that you're diversified and you don't have all your eggs in one basket. So you can continue to understand what is currently happening and how these different things can affect your pockets and affect your returns on many different investment vehicles. Being able to say gold is one asset that performs typically well under different turmoils. Gold has done well during recessions, during a lot of different hardships, economic and uncertainty. So being able to have that diversified within your portfolio is good. But when it shows about gold making all-time high, it shows a lot of uncertainty, and it shows a lot of different things where it's about trust, that there's not much trust within the current outlook and where things are headed towards the future. And going back to dollar devaluation and inflation pressure, is that the U.S. dollar has the biggest first half decline in over 50 years. So this is something where this has been driven by slower U.S. growth, expectations to be able to continue to have fiscal deficits, be able to have tariff policies that have continued to affect this tremendously. And the weaker dollar helps exports, but also hurts imports at the same time with the supply and demand and many different things, but hurts consumers. That's the biggest thing. A lot of these different prices that we've seen has been passed down to different consumers, making things more expensive and having consumers having less money at the end of the month after things continue to get more expensive. And basically impact breakdown, say basically for consumers makes a higher price on imports like electronics, cars, and clothing. More expensive to travel abroad to different countries or different places. People are going to be traveling less to places that they want. They're going to be able to focus more on things like saving, because then you actually buy day-to-day necessities. And then decreasing purchasing power. If things are more expensive to buy, they don't have as much money at the end of the month, like I mentioned. You have to be able to have less things that you can purchase. So you have to be a lot more frugal with what you're spending on. And for the economy, It can be very mixed, is that it can boost exports to the US and much cheaper abroad, but it can also have potential job boosts in export industries. But at the same time, it can have inflation pressure from different imports, which can cause it to continue to rise with many of these tariffs going into place. And then inflation pressures a lot of these imports, making things a lot more, the value of your dollar going up, things making things more expensive. But that the main causes for that has just been the policy uncertainty during tariffs, geopolitical shifts, and deficits that have continued to rise within debt and different trades and jobless claims. The slowing U.S. growth forecast, especially with a lot of companies and a lot of countries being able to move away from the U.S. dollar, and then the Fed expects to cut rates faster than global peers. But the weaker dollar quietly taxes savers, which is important because it just devalues your dollar. But every imported good costs more, and your cash buys less unless it's working for you. So if you're not putting your money into different investment assets, then your money will continue to go down in value if you're just holding cash. A lot of things this has contributed to a lot of different things like global geopolitical recession, just like a lot of different outlooks. Not really a recession, but there's been a great power competition that U.S., China, Russia tensions have continued to escalate, which have multilateral cooperation weakening. So without these different tensions between different governments, with tariffs, conflict, trade, has caused a lot of uncertainty. A lot of different sanctions, tariffs, and trade barriers are now being used to weaken the influence of weapons of influence to be able to help these different companies and countries be able to have power or negotiations. And then a lot of different populist movements rising, central institutions losing credibility. So a lot of these different monetary policy and different governments, a lot of people are pulling their money out of these different central banks into alternative assets like gold, like cryptocurrency, and then other alternative assets as well. And then just be able to conflicts is fueling global instability. Regular people do not win, are not profitable based off of war, but people that are invested into different military defense, which instability leads to lower productivity, and then volatile markets continue to affect and slower long-term growth because no one really wins unless you're on the side of military defense. And this has cost the economy literally 2% below forecast for 2026. And the private investment FDI down as policy risks continue to rise. And then the public trust erosion, the markets are more reactive to many of these headlines that we've seen with jobless claims, with inflation, with things like that, has caused a lot of weakening U.S. economy and global outlook. But it's not just about political, but it's also financial. When governments lose credibility, currencies lose value, and that makes things worse for the global outlook. So it's important to understand what these different decisions do and how they can affect your pockets overall. So how can we be able to utilize our information, and how can we implement this to be able to put ourselves in the best situations, not be fearful, but how we can be able to allocate our different resources to different sectors so we can be successful. And like I mentioned, a lot of different countries have increased military spending, has surged to $2.7 trillion record, is up 9.4% year over year. It's the largest jump since the Cold War. And the trade-off, every $1 billion that's in military budget could fund mass vaccination, hunger relief, or climate adaptation. And the UN warns that the world is spending more on war than on peace, which is not really good. The economic effect can be increases public debt, reduces funding for social programs, which can cut many different things for certain people that need certain services. And it fuels arms races, which continues to further instability, and then continues to reach higher inflation as we continue to spend more on goods and services and the weakening US dollar and dollars worldwide. We're financing weapons with borrowed money, but we're starving innovation, education, stability. Even though we have artificial intelligence, majority of these companies are not doing well. So it's important to understand what's really actually happening behind the scenes. And a lot of AI investment, we're betting on the AI wave to continue to grow. The new industrial revolution is like the current AI revolution. Nvidia has invested in $2 billion into Musk XAI and put a 20 billion funding round, half debt, half equity. That's something that's stacked by Nvidia's GPUs, which is creating a new asset class of AI infrastructure debt. So this is something as Nvidia continues to build, they're paving their way as the center point of the AI revolution. Be it making strategic partnerships so they can continue to position themselves as not just the AI chip maker, but the whole entire ecosystem that's needed in order to power the AI generation, AI technology, to be able to build these different systems and data centers so that they can continue to be the backbone of the AI infrastructure outlook moving to the future. Energy strain, but this has cost a lot for energy. The United States government does not have enough energy to power many of these data centers that we see that powers many of these different large language models and things like ChatGPT, Anthropic, Claude, XAI. They need a lot of energy. The U.S. data centers already consume 176 gigawatts. No, 176 TWh, which is 4.4% of electricity, which could reach 12% by 2028, which is literally almost quadrupling the need for energy. The grid is at risk. The coal plants are continuing to retire, but gas demand rising and clean energy is delayed, which can cause a lot of tech growth, not directly a national energy policy and grid reliability. They need to be able to have more energy to be able to power many of these different systems, because if without it, then this AI revolution cannot go as far and be as efficient as they want it. So being able to understand that which companies are positioning themselves as providing more energy so that they can be able to build enough data and be able to build those data centers to power their different large language models to be able to build up the infrastructure for artificial intelligence. AI runs on electricity in America. This grid wasn't built for this kind of demand that we've seen at a rate that's never been seen before. So energy is really what's powering this next generation of technology. And when we look at which companies are being able to position themselves, buying up land, building up different data centers, which ones are continuing to build their own energy so that they can be successful as a company throughout the long run. And then looking at a lot of market money flow value meets reality. OpenAI has now valued at $500 billion, making it the most valuable privately held company in the world. And that's something that's so important, because they're continuing to be the chosen one. They're the chosen company to be able to power this next AI wave for the next generation. They're one of the most valuable privately held companies. I guess the most valuable privately held company. And it's important that they're continuing to be positioned for success, especially when they continue to go private and these other different rounds, so that they can continue to lead the way for enterprise and artificial intelligence. Oracle is expanding $38 billion debt rise for cloud infrastructure. Oracle has positioned themselves for energy, and then cloud is just something that they're continuing to build off of. Meta and Amazon are doubling down on AI hardware that could drive data centers. And then Microsoft Copilot and Azure dominate enterprise AI integration. And then looking at these different risks that a lot of these big companies are in AI. About 40% of the US stock market is in top 10 tech, which is total nearly 40% of the US market cap. And many of them warn of a bubble-like feedback loop. But we see that a lot of these AI systems, a lot of different companies you look at back in 1998, 2000, is that a lot of when the internet first came, there was a lot of companies that weren't really proven. They were off of a lot of hype, a lot of speculation. And that's similar here with the artificial intelligence movement. Even though there is a huge risk for hyper concentration in AI, the companies who will be able to perform very well and continue to increase their margins, being exceptional at what they do, and building the AI infrastructure will be the companies that will be successful in this new AI wave. Not different companies that are just doing things to just do good at one thing, but if they're the ones that are the backbone, the infrastructure, the energy, and also have something that no other company involves, will be the people that will stay around in this AI movement. But the biggest bet on Wall Street is that it's the success of artificial intelligence empowering the next generation of these different systems and models. Once we get enough energy, we get enough data that we can be able to offer these systems to the everyday person. But concentration risk is very real for many people that look at your portfolio being all in tech. That's why you want to be diversified. You don't want to have all your portfolio in technology. You want to look at some of these other industries and see which companies are going to be successful, that have a moat, that have strong cash flow, and are well positioned for success moving towards the future. And this puts us into a bigger picture. Like, what is the ultra wealthy strategy? Is to be able to preserve, diversify, and outpace. So many people don't understand that wealth is viewed as one integrated system. It's not every account, trust, and investment works together. A lot of wealthy individuals are not worried about just putting their money in cash. They use cash to invest in other vehicles. They focus on risk-adjusted returns, not just highest returns. They build around tax efficiency, diversification, and purpose. Instead of us being able to look at a W-2 job, we pay more taxes because of the tax system. The tax system was built for big business and for different infrastructure because theoretically they're taking a risk. For real estate, you're providing housing that the government doesn't have to have. If you're owning a business, you're providing different service and economic impact to different situations that employs different people within the community. So the U.S. government gives out tax incentives for different companies that are able to pave the way and provide economic growth for certain areas. They're very focused about being able to put their money into, many people own their home, but the wealthy use their home as a tax efficient strategy, as well as a cash flow to be able to reinvest their money from different their businesses, such as depreciation, such as many other different 1031 exchanges, be able to leverage and be able to have those assets work for them, where we own our house, but the wealthy own nothing. Their company owns stuff. They have foundations that give charitable givings, which can give tax deductions, which continue to have the LLC, which has that tax flow that goes into their foundation to be able to offshore the money tax-free and then be able to pass that down and borrow against it and continue to move with different tax-efficient strategies. The private equity and venture is basically for their growth, innovation, asymmetric upside, be able to invest in many of these different companies like OpenAI, Apple, Amazon, Google, invest in these companies before they even go public and be able to get their rounds and invest and make high returns. Real estate is used typically for income and as an inflation hedge. So just having your money just inside cash or just having in stocks, you have something that's physical, something that can get depreciation and something that has appreciation over time, which is very good if you want to be able to leverage to be able to buy more assets and be able to get more and build up more equity in that to be able to have an inflation hedge. Hedge funds is the downside protection in someone's portfolio. And commodities like gold and silver is like a store of value. It's something to hedge against inflation, to not have all your eggs in one basket like stocks and equities, but be able to have that as something that is tangible, that can be able to have a store of value that typically goes up when there's a lot of instability and different uncertain times. And in global equities is diversified growth exposure, not just having US stock market, but having exposure to markets in Asia and Africa and in Europe, so that they can be able to have those different avenues of success regardless of where they are in the world, because not every year the US stock market is not going to be the best, and not every single year commodities or real estate are going to have the best year. So they're going to have those different sectors so that they're prepared for all weather portfolio, whether the stock market's up, down, sideways, or any other direction. So it's important to have that different asset classes work for you. Wealth don't just grow money, they protect its buying power. The first rule is defense. A lot of people look at the upside of building capital, but they don't look at the defense mode. They don't look at the taxes. They don't look at the leverage. They don't look at the passing it down for generations or being able to look at those different things. They don't do it just to be able to spend money. They use money to buy vehicles and clothes and things like that for tax efficiency and also structure for their business so that they can be able to build more wealth and borrow against it and pay themselves back and have their money work for them and grow for them tax-free, legally, which is so important. It's not about how much you make, but it's about how much you can keep as a person that's truly building wealth. And pretty much practical money moves that people can learn is playing the economic game. Is be able to don't just have move idle cash. Don't high yield savings account, money market CDs. Have your money work for you. Get at least 3.5, 4%, 5% on your money, because you're losing with your money's going down with inflation. If you have less than 0.00001%, you have to have your money work for you. And you can use that with a high yield savings account, a CD or a money market, which is important. And pay down variable cash rate debt. It's important. You cannot be able to invest if you have high rates of debt, which continue to appreciate over time, that continue to accumulate over time. You have to pay off your debt. Keep 6 months to a year of cash, unless there's an emergency, something comes up, car, things like that. You still have to live. So have 6 months to a year saved up, and invest outpace inflation. Prioritize many different stocks with pricing power, such as energy, healthcare, commodities. Diversify in foreign markets and real estate, gold, REIT, and farmland. And remember that cash equals negative yield during inflation. So if you're just carrying cash and it's not working for you, it's going down in value. So you have to put your money into something that's going to give you interest on your interest on top of your cash, was always moving in a cycle, growing more and more each and every year. And plan for scenarios. Stress test your plan for a 20% market dip or temporary job loss. Would you be able to afford your expenses if you were to lose your job? Would you be able to invest more money if the market were to go down 20%? Would you be able to live your life and not be in a survival mode if things were to happen? Because life will happen, but it's about how you prepare before things happen, before things get bad, before situations get sticky. You want to be able to prepare yourself so that you can be successful no matter what. Build flexibility. Liquidity and low debt give you control. If you're someone that has all your money in real estate, but you don't have any cash, that's very, very risky. You can be a house rich, cash poor, but you want to be able to have cash on the side that you can be able to use if you were to have a new opportunity or something were to come up. Because you can't just sell your real estate, multi-million-dollar real estate, multi-$100,000 property in a couple of seconds. You want to have some money as cash, have your money in real estate, have your money in different avenues, so that if things were to happen, you don't have to be able to scramble and try to sell all your assets at one time. But if you have more than 6 months to a year of cash, you're really not doing much for you. So make your money work for you, or your money will go down in value. But my main thing is be able to have, this is one of the most dynamic markets and environments in 50 years. The AI is reshaping the industry. Gold is continuing to be rewriting monetary trust. And the dollar's decline is a reminder that even reserve currencies can wobble. Like the smart money isn't panicking. It's preparation. Protect your purchasing power. Diversify globally. And stay ready to pivot with purpose, because creating wealth is not just about how much money you make. It's about the mindset. It's about how you truly view money. Will you use money just to buy expensive cars, buy things to impress other people, or just to be able to look a different way that people want you to see as? Or is this something that you can be able to change and transform your life? Be able to go and put your family in a better situation, investing in yourself, be able to expand and help more people, be able to help you find your purpose, not having to just rely on just only your job. Because people in my generation, we may not have Social Security. We don't know what job security might look like in 5, 10, 20 years. We don't know what the global outlook would look like. So if we want to prepare ourselves for a rainy day, we want to be able to prepare ourselves for an amazing day. We want to prepare ourselves for wealth. We want to prepare ourselves for growth. We want to prepare ourselves that we truly deserve, that we can have it. It's not about just having money just to have it, but it's about being able to provide opportunity that those things can give you, that can transform your family, that can put you in a better situation where you can thrive instead of being in survival mode. That's something that we can truly use this information and share at the family table, so we can all rebuild our communities, that we can all have a right, that we can deserve to be wealthy, that we can be wealthy, and that things that we can do is truly attainable. In this market, in this environment, there's a lot of different things happening where we think only the wealthy can have these different things. But no, this information was intentionally not taught to us, so we don't know how we can truly be free. The whole entire system was made where just having the job, work for 30 years, and having true loyalty within different companies has truly been a thing of the past. Not saying there aren't good companies out there, but we need to be able to position ourselves for the next 10, 20, 30 years, depending on how long you'll live. But just know that you can put your life in your hands and not have to rely on anyone else to be able to hold it for you. that you don't have to decide that your job decides on how many days you have free. Your job doesn't decide when you get to spend time with your family. Your job doesn't have to be able to help you when you're someone that's going to have to retire one day, that you can be able to live and be able to see your family grow and thrive and be wealthy, not just in money, but in mindset, but in heart and your community and your purpose and all avenues of life. And being financially free is the first thing that people can see that can help you build that. Having that foundation and that faith. If you don't believe you can do it, then you won't be able to have it. So having all those different things in your life is the true success means to me. And me being 22 years old, it's been an honor to be able to help thousands of people learn this information. And this is the most important time that we say, well, just the best time was yesterday. No, but the second best time is today. You can't worry about things that you didn't do yesterday, but you can control how you act today and how you continue to move tomorrow. It's not about being the smartest. It's not about being someone that's prepared or someone with the most information. It's about execution. It's about being able to take action and implement it in your life, whether that's $5, whether that's $10, whether that's $1,000. Start somewhere. Start with your purpose, start with intention, and execute. And you will see your life change trajectory. You'll see that $5 growing, like the $100, $1,000, $10,000, $1 million starts with $1, 1 cent into your bank account. And you taking the action that you deserve, that you can be financially free. And that starts with you. And that will conclude this video today. Make sure to like and subscribe and share this information to your friends and family. Make sure to follow me on Instagram at Phillips3. Subscribe to YouTube. And we'll be back with this each and every week to finish off this year. My name is Corey Phillips, 22-year-old founder, CEO of Social Storm LLC, and you will have an amazing night. Bye.